Before Warren Buffett was the Oracle of Omaha, before the billions, before the fame, before the shareholder letters quoted like scripture, there was just a young man sitting in a library reading a single book. That book didn't just change how he invested, it changed who he became. It's called The Intelligent Investor, and today we're breaking down exactly how it shaped Warren Buffett's entire approach to wealth and what you can learn from it, even if you're starting from zero. In 1949, a 19-year-old Warren Buffett picked up a freshly published book by Benjamin Graham, a book he would later call the best investing book ever written. He didn't just read it. He absorbed it. Page by page, idea by idea, Buffett realized something no one had told him before, that investing wasn't about predictions or hype or flashy trades. It was about principles, discipline, margin of safety. This wasn't just a strategy, it was a mindset, and the most important part? It worked. The kid who read that book would go on to build a $100 billion fortune by doing the exact opposite of what most investors do today. If you're serious about building wealth, not chasing trends, hit that subscribe button right now. In this video, we'll unpack the core ideas from The Intelligent Investor, show how Buffett applied them in the real world, and how you can use the same mindset to protect and grow your money, even in chaotic markets. Let's kick things off with the simple truth. Warren Buffett didn't invent his investment philosophy from scratch. He inherited it from Benjamin Graham, the man he called his greatest mentor. When Buffett first read The Intelligent Investor, something clicked. He later said, "I read the first edition in 1949. I thought it was by far the best book on investing ever written. And unlike most financial books that get outdated fast, this one became his compass, even 70 years later." Graham's approach was brutally logical. He taught Buffett to view a stock not as a number on a screen, but as partial ownership of a real business. That one mental shift rewired Buffett's brain. Suddenly, the goal wasn't to predict the market. It was to buy businesses at a discount to their intrinsic value. If he could do that with discipline and patience, everything else would take care of itself. This idea, intrinsic value, became the foundation of Buffett's empire. In fact, many of his greatest investments, from Coca-Cola to American Express, followed this formula. Buy strong companies when they're undervalued and hold them forever. No flashy trades, no fear of volatility, just calculated conviction. What's wild is that Graham wasn't promising excitement. He promised protection. Preservation first, profits second. And that's why the book resonated with Buffett so deeply. He didn't want to gamble. He wanted to build something that lasted. And that's exactly what he did. Now let's talk about one of the most powerful and misunderstood ideas from The Intelligent Investor that Warren Buffett has used his entire career: the margin of safety. This concept is so simple, yet so profound, that Buffett has called it the single most important concept in investing. And once you understand it, you'll never look at money the same way again. So what does it mean? In short, never risk everything for a little extra return. Instead, always leave a buffer between what something is worth and what you pay for it, because the future is uncertain. Benjamin Graham described it like this: "The margin of safety is always needed because valuation is an imprecise art. In other words, build in room for error. Even if you're smart, even if your analysis is great, because nobody is right 100% of the time." Buffett took that idea and made it his golden rule. When he bought stocks like Washington Post or Geico decades ago, he didn't do it because they were exciting. He did it because their market price was way below their intrinsic value, giving him downside protection and massive upside. That's margin of safety in action. And this is exactly how The Intelligent Investor shaped Warren Buffett. Because Buffett's genius wasn't just about what he bought, it was about how little risk he took to get massive results. He wasn't swinging for the fences, he was building in parachutes, and in a world where everyone's chasing the next moonshot, that kind of thinking, it's more valuable than ever. Now let's talk about a strange character introduced in The Intelligent Investor, one who became a lifelong lesson for Buffett, Mr. Market. Benjamin Graham described Mr. Market as your manic business partner who shows up every day offering to buy your shares or sell you his. But here's the twist. His mood swings wildly. Some days he's euphoric, offering sky-high prices. Other days he's depressed, practically giving things away. The lesson? You don't have to follow him. You can ignore him. And if you're smart, you'll only deal with him when he's wrong in your favor. Buffett has said that this metaphor was one of the most valuable tools he ever learned. Why? Because it freed him from the emotional chaos of the stock market. While most investors panic during downturns or get greedy during booms, Buffett learned to treat market prices as offers, not orders. If the price is right, he buys. If not, he waits. Simple, rational, unshaken. Let me give you a real-world example. During the 2008 financial crisis, while the world was selling, Buffett invested billions in companies like Goldman Sachs and Bank of America because Mr. Market was in full panic mode, and the deals were too good to ignore. And here's the deeper insight. Mr. Market isn't just the stock market, it's also your own emotions, fear, FOMO, regret. Graham taught Buffett how to separate price from value, and that one lesson gave him the clarity to act when others froze. We'll go deeper into Buffett's temperament in a moment. But first, let's look at how this framework influenced some of his biggest real-world decisions, and what you can learn from them. Let's connect the dots between what Buffett learned from The Intelligent Investor and the legendary investments he actually made. Because it's one thing to read a good book, it's another to build a $100 billion empire on its principles. And Buffett didn't just apply Graham's ideas in theory. He used them to make real decisions with real money, often in moments of crisis when most people were too afraid to act. Take his early investment in Geico, for example. Buffett studied the company's fundamentals, saw that it had a durable competitive advantage and was massively undervalued, and went all in. Not because it was hyped, but because it fit Graham's framework of intrinsic value with a wide margin of safety. Geico later became one of Berkshire Hathaway's crown jewels. Or look at Coca-Cola. Buffett didn't buy it because it was trendy. In fact, he waited until the late 80s, after a crash, to scoop it up at a price well below its intrinsic value. He saw a global brand with pricing power, loyal customers, and decades of predictable earnings. Classic Graham playbook. And he's held it ever since. That's the pattern. Strong companies, bought at a discount, held with conviction. And that's how The Intelligent Investor shaped Warren Buffett. Every major Buffett win traces back to what Graham taught him. Avoid speculation, embrace discipline, and let value lead the way. Up next, we're going to explore the emotional side of Buffett's genius, the part most people overlook, but Graham deeply understood. Let's dive in. Let's talk about the one thing that really separates Warren Buffett from the average investor. And no, it's not IQ, it's emotional control. Graham hammered this idea in The Intelligent Investor over and over again. Successful investing is not about brilliance, it's about behavior, it's about temperament. And that's where Buffett truly shines. In fact, Buffett has said himself, if you're not able to control your emotions, you're not fit to manage other people's money or your own. He's not just talking about panic selling during a crash. He's talking about resisting hype during booms, ignoring the noise, and having the patience to sit still when others are scrambling for action. This discipline is how he stayed calm during Black Monday in 1987. It's how he doubled down during the dot-com bust, and it's how he found opportunities in 2008 when others saw only disaster. That's not luck. That's emotional skill, built on Graham's core idea, that the market is not your master, it's your servant if you stay rational. And here's the twist. Emotional discipline is trainable. You don't need to be born with it. You just need a process, one that grounds you in logic, not noise. That's why Buffett reads hundreds of pages a day. That's why he tracks businesses over years, not weeks, because he's playing a completely different game. And as we'll see in the next lesson, Buffett's long-term mindset, shaped directly by Graham, is what allows him to buy and hold when everyone else is busy buying and selling. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Now let's move to one of the most counterintuitive and powerful lessons Buffett took from The Intelligent Investor. Wealth isn't built by timing the market. It's built by time in the market, and Graham made this crystal clear. The real edge isn't found in forecasts, charts, or predictions. It's in patience, the ability to buy something valuable and just let it grow. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." That one quote sums up the entire difference between his approach and the mainstream. While day traders chase volatility and try to outsmart headlines, Buffett quietly accumulates ownership in high-quality businesses and holds them for decades. Look at his Coca-Cola stake, bought in 1988, still holding, or American Express, purchased in the 60s, still in the portfolio. Why? Because they generate predictable earnings, have strong moats, and he bought them at attractive valuations. Nothing flashy, just compound interest working its magic. This idea, holding for the long term, came directly from Graham's philosophy. In fact, The Intelligent Investor warns readers to avoid the trap of market forecasts and instead focus on what you can control: your behavior, your time horizon, and your margin of safety. That's why this video keeps returning to one powerful idea. Wealth isn't about brilliance. It's about behavior. Buffett didn't beat the system by moving fast. He beat it by moving rarely and letting time do the compounding for him. Now that you understand the power of time in the market, let's talk about something that's become even harder today than it was in Graham's era: tuning out the noise. Because in a world filled with 24/7 headlines, TikTok stock tips, and YouTube thumbnails screaming about crashes and booms, staying focused is harder than ever. But Warren Buffett learned early, thanks to The Intelligent Investor, to separate signal from noise. Graham warned that the market is not a reliable barometer of a company's worth in the short term. It's a voting machine in the short term and a weighing machine in the long term. Buffett took this to heart. He doesn't panic when prices swing. He doesn't celebrate when stocks spike. He stays laser-focused on the actual business underneath: cash flow, management, brand power, return on equity. That's signal. Everything else, just noise. This mindset is what allowed him to completely ignore the dot-com bubble. While others were chasing tech stocks with no earnings, Buffett stuck with businesses he could actually understand. People mocked him for it at the time, until the bubble burst, and he walked away with billions in dry powder ready to deploy. The key insight here? Buffett's information diet is curated. He reads annual reports, not trending tweets. He studies balance sheets, not predictions. Because as Graham taught him, most information is entertainment pretending to be insight. Let's bring everything full circle. You don't need billions to apply the lessons from The Intelligent Investor. You just need the mindset Warren Buffett adopted and stayed loyal to since age 19. Because what made Buffett extraordinary wasn't access or luck. It was his decision to follow principles most people ignore. He used margin of safety to avoid losing money. He saw stocks as businesses, not tickers. He waited for Mr. Market to offer a deal instead of chasing hype. He focused on emotional discipline when others lost control. He let time, not timing, do the compounding. And most importantly, he blocked out noise and stayed focused on signal. All of these came straight from the book we've been talking about. And that's why this video is titled, How the Intelligent Investor Shaped Warren Buffett. Because it didn't just teach him how to invest, it taught him how to think. And that's the part you can replicate, even if you're starting with $10. So what can you do? Start small. Read the right things, track your investments, define your rules, avoid speculation, prioritize clarity, and hold your best decisions long enough to let them work. Wealth isn't built by chasing everything. It's built by understanding a few timeless truths and actually following them. Let's recap what we covered. because there's a reason this book still shapes investors 75 years later. Buffett didn't use complex charts or trendy strategies. He used core principles from The Intelligent Investor. Focus on intrinsic value, demand a margin of safety, ignore market mood swings, hold great businesses for decades, and keep your emotions in check. These ideas aren't fancy. They're just true. And that's why they've compounded into billions. You don't have to be Warren Buffett to follow his path. Start with awareness. Understand what you're buying and why. Avoid hype. Be okay missing out on short-term gains in exchange for long-term wealth. Build a habit of reading real reports instead of scrolling through noise. And most of all, be patient. The greatest investment you'll ever make is in your thinking. And if you're watching this, you're already on the right track. Start where you are, stay consistent, and let the decades do the heavy lifting. Because wealth isn't about speed, it's about direction. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.